Hey, this is our third and final webinar in the CitySwitch series on mandatory climate reporting. This webinar will focus on navigating the reporting process and finalising disclosures. If you have any questions throughout the session, please drop them into the Q&A chat and we'll have some time at the end to answer these questions. So today we're joined by Reground Agency, our campaign partner. We'll also be hearing from our guest speakers, including Emily Simso from New Forests, Sophie Duggany from KPMG, and Nina Larson from Reground. A big thank you to all our speakers for joining us today. Next slide, please, Abby. Before we make a start today, I just want to acknowledge the traditional owners of the lands I'm joining you from today, the Gadigal of the Eora Nation, and I'd like to pay my respects to traditional owners of the lands I'm joining you from today. I pay my respects to elders past, present, and emerging, and to any Aboriginal and Torres Strait Islander people on this call. Next slide, please, Abby. So this webinar series is delivered to you by CitySwitch. We are a free national program led by local governments focused on supporting businesses in the commercial office sector to work towards net zero. We're coordinated by the City of Sydney and joined by North Sydney, City of Melbourne, City of Ballarat, City of Yarra, City of Port Phillip as council funding partners. We also have a dedicated national program manager to assist businesses located outside of these participating council areas. We also partner with Neighbours, an environmental performance benchmarking tool, and supported by the Department of Climate Change, Energy, Environment and Water of the federal government. So CitySwitch as a programme is designed to simplify and structure the journey towards net zero, to help businesses understand best practice and provide an opportunity to build collective knowledge, to connect businesses along the way as well, and to have a programme to be accountable and track your progress towards your journey towards net zero. Each year we have or deliver 3 educational campaigns based on our net zero pathway, covering actions such as waste, energy efficiency, greening your supply chain, and most recently, reducing your travel emissions. If you'd like to hear more about CitySwitch, please feel free to contact me to set up a quick chat. We welcome any commercial office-based business across Australia and wherever they are on their net zero journey. I'll drop my email into the chat. Next slide, please, Abby. So our mandatory climate reporting campaign has included 3 educational webinars, and will be accompanied by an educational guide, which will be published soon. We have also aligned our annual reporting data collection sheet with the ASRS legislation to streamline our reporting period for the programme. Last week, in our second webinar, we dove into data collection and reporting and covered data collection reporting requirements and tips for data sharing and engagement between groups 1 to 3 and small SMEs as well. We also looked at some example timeframes for data collection and some guidance on preparing for assurance, in particular what auditors look for and how to be audit ready. We also heard from guest speakers from YMCA Victoria, Bank Australia and Climate Zero. So this week's webinar will cover how businesses can navigate the reporting period and finalising your disclosure. We'll also hear insights from our guest speakers and their experiences. I'll now hand over to Reground Agency to kick off the session. Over to you, Abby.
Great, thank you so much, Yvonne, and welcome everyone to this third and final webinar in the series. Before I begin, I'd also like to acknowledge country that I'm joining from today, and my colleague Sophie. We're in Wurundjeri country, and acknowledge all elders past, present and emerging as the traditional owners of the land that we're based on. We're really thrilled to be running through this final session. I won't give too much of an introduction to us because you've probably come across us in one of the other webinars already, but we do a lot of work in climate advisory and risk, and it's been a real pleasure to share our knowledge and insights and invite such great guest speakers to join these sessions. And this certainly is an action-packed session today. So it is a bit more technical today. It is, I would say, a little bit heavier content. So we have been working up to this point slowly. So hopefully the more introductory content in webinar 1 and then the data focus last week will put you in a good position to start getting your heads around some concepts that we will uncover today. However, we do acknowledge that some of it might be a little bit more on the advanced side, and all of the content will be summarised further in the educational guide that Yvonne just mentioned for members. So we certainly do encourage you to become a CitySwitch member if you're not already, so you can make use of all the amazing resources that the program offers. To begin with, we also did want to acknowledge that this webinar is purely for educational purposes. It's around trying to upskill, give knowledge, try and build a deeper understanding of the Australian sustainability reporting standards. We are not qualified to give financial or legal advice, and the information shared in here is not designed to help you meet your compliance requirements necessarily. So it's just for educational purposes only. In this session, it'll be the same format as last week. So we will be finishing at 1:15 p.m. So hopefully you can all stay on until 1:15 because we've got some great discussion with our guest speakers at the end of the session. The first 30 minutes again will be content delivery, followed by 5 minutes of guest speaker presentations each, and then we'll have a 20-minute panel discussion and roughly 10 minutes for audience Q&A questions at the end. But as Yvonne did say, put your questions into the Q&A as we go, and we'll try and answer as many of them as we can in this webinar. So the agenda for the content, first of all, will be unpacking materiality. So getting a bit under the hood of what is materiality and what does that look like in the context of the mandatory climate reporting here in Australia. We'll then discuss some practical details around report compilation and lodgement and finalising the disclosures. And then we'll discuss example disclosures and best practice and where to look for further guidance. Yvonne's already mentioned our great guest speakers. So today we've got Reground, New Forests and KPMG. To begin with, we wanted to kick off again with a poll. So we have a QR code up here on the screen. We'll just have this here momentarily. If you can get your phone, scan the QR code or head to menti.com and use the code 32817904. Just wait maybe a few more seconds here, and I can see Sophie has put that link directly in the chat too. So with that, I might move on. Hopefully everyone has found it. The code will remain in the chat and at the top here on the screen if you need it. So the first question is whether you attended or have already watched the recording of webinar 1 and or webinar 2. Amazing. Can see lots of you have already been across both, which is excellent. And if you haven't, that is fine too. Just know that we're not re-summarizing anything that we've already gone through in those sessions today. So if there's something you want to refer back to, we'll have the recordings available in the chat, and following this email as well, we'll be sharing the recordings out with everyone. Thank you for that. And just one more poll before we move on. Interested to know what aspects of navigating the reporting process and finalising disclosures you're wanting to learn more about. So the options we've got here are materiality, directors' duties, lodgement with ASIC, compliance risks and enforcement, or where to look for guidance. And if anyone did select that other option there, feel free to put that in the Q&A as well, or you can also add that into the feedback survey at the end. So we make sure that we try and cover as much ground as we can in the educational guide. But great, good to see that lots of you are interested in materiality and where to look for further guidance, because we'll certainly be covering all of these topics in today's session. So hopefully that'll be really valuable for you all. Wonderful, thank you. So in terms of materiality, many of you have probably heard of materiality before, but we really wanted to just touch on what it is in the context of the Australian Sustainability Reporting Standards, so the ASRS. Essentially, there's two main ways that materiality comes into play in respect to the ASRS. So there's a difference between what constitutes material risks and opportunities that would come out of the climate scenarios scenario analysis, for example, versus what constitutes material information to sit within the disclosures themselves, versus what might be related information but doesn't actually end up in the final sustainability report. So basically, material risks and opportunities are, I mean, all of this is up to the organisation to determine what is material. So the ASRS, the Accounting Standards Board, they don't stipulate any criteria or specific rules necessarily around what is a material risk and opportunity, because they basically give that responsibility up to the organisations to determine themselves. And the same goes for material information. It's up to the organisation to make judgments on what they believe constitutes relevant information. So essentially, when looking at risks and opportunities, it would be generally determined by nature of magnitude, or the type of climate variable or impact, for example. Typically, we'll touch on in a second the difference between financial and double materiality, but typically this is all just looking at financial risks and opportunities. When it comes to information, it's really around whether omitting, misstating, or obscuring the information could reasonably be expected to influence decisions of primary users of the reports. So those are the two different types of materiality that we're talking about when it comes to the ASRS. So the standard doesn't stipulate a requirement for what we call double materiality, and there's a difference. Essentially, materiality is generally referred to just in a financial sense traditionally. So it's really looking at if something is relevant from a financial perspective. Whereas double materiality is not just looking at those external events that could impact on the business's profitability and cash flow and financial performance, but it's also looking at the type of impacts that that organisation could have externally. So, for example, there could be a big emitter that has somehow determined that they don't have any financially material risks or opportunities. However, if they're not looking at that from a double materiality perspective, they're perhaps not showing the whole picture of those external impacts that they are having. So the way that the standard is all worded is certainly around financial materiality in this context. It's not like the European sustainability reporting standards, where there is a specific mandate for a double materiality assessment to have occurred. The standard itself actually does not even ask for a materiality assessment to be undertaken specifically. It asks for the scenario analysis to be undertaken, and then for the organisation to determine what the material risks and opportunities are from that scenario analysis. So hopefully that helps to explain a little bit of the difference between financial and double materiality. And when it comes to determining materiality thresholds, both for the risks and opportunities and then for the material information, we have a few considerations that we've summarised here. These will be covered further in the educational guide because there's quite a lot to unpack. But essentially, when you're looking at the scenario analysis, that would typically be evaluated as via a model that estimates through a range of assumptions and reasonable projections the estimated impacts generally on profit margins, or a construction company, it could be average contract values. There's quite specific financial metrics that would need to be put in place, and ideally they would align with the way that the organisation is currently assessing financial risk in other aspects of their business outside of climate. Risks themselves are generally evaluated via their severity, so the scale, scope, and irremediability of the risk and the likelihood. And having this clear criteria in place, so when you go through the scenario analysis and you identify the potential climate variables and projections and the flow-on effects, the impacts associated with those, and then the severity and the likelihood, it starts to help the auditor to have a really clear, logical, step-by-step process that they can see how you got from A to B and how you've determined what is material or not. There are some quite relatively new concepts out there, such as climate value at risks, models out there that actually have a lot of work that have gone into them to determine the sorts of financial flow-on effects that can generally be expected from certain sorts of events happening, particularly tying it back to the 1.5 degree warming scenario versus the scenario of well above 2 degrees as well. So getting your heads around climate value at risk concepts, again, we'll chat more about that in the educational guide, and really starting to implement clear structures and processes will be really key for undertaking that materiality assessment as part of the scenario analysis. When it comes to relevant information, again, having clear criteria to determine what material is relevant based on the significance of that material and its decision usefulness. So realistically, how useful is it for a shareholder, an investor, a lender, someone who's reading these reports to be able to make decisions, informed decisions about the company and their dealings with the company. So having clear criteria to determine what sits in and outside of the report is really pivotal here. Then when we move on to report compilation and lodgement. So here we have some best practice guides for finalising the disclosures. Essentially, there's a lot of stuff that is listed here that we've touched on already in the webinar series, but allowing sufficient time is pivotal here. There's going to need to be some internal debates and reviews and lots of questions that committees, board, directors all ask. And if there's not enough time allowed for those sorts of reviews to happen, it's going to make being able to make any changes really tight and quite stressful. So allowing enough time is critical. Ensuring directors are equipped with knowledge of the types of questions that they should be asking. We will speak about that in a moment in regards to a director's actual responsibilities with these standards. Engaging with auditors early on, we've spoken about that and the importance of undertaking ideally a pre-assurance gap analysis to understand how ready you are for that assurance process to take place. Identifying those material thresholds early on, we've just spoken about that now. We spoke about last week as well, having that compliance screening process, so an index table that basically maps all the requirements of the disclosures back to the standard. That's something that ASIC encourages everyone to do. And also doing a greenwashing risk review, so being very cautious of using any sorts of terminology around carbon neutral or net zero or net positive or even sustainability, like trying to just have a very risk-based lens upon all of those sort of claims and terminology, because they are things that the ACCC and ASIC and legislation in the EU is really cracking down on. So where will the reports be located? The sustainability report will comprise the fourth report in the annual reporting suite. So there'll be the financial report, the director's report, the sustainability report, and then the auditor's report on both the financial and sustainability report. The sustainability report can be limited just to the climate disclosures. You don't have to have the voluntary AASBS 1 content within the sustainability report. If you do, though, however, have those voluntary statements in there, you need to make sure that you're not obscuring this climate-related disclosures from those statements, so they need to be really easily accessible. The reporting period must cover the same financial cycle as the rest of the organisation's financial reporting. So if that's on a calendar year basis, climate reports are on a calendar year basis, and vice versa for those on a July 1 to 30 June cycle. We did have an interesting question related to this recently, which was around if the organisation, such as a listed company, has half-yearly reports, do they need to publish climate disclosures along with those half-yearly results? The answer to that is no. This is just limited to an annual sustainability report. Where will the reports be lodged? They will be lodged with ASIC in the same way that financial reports are lodged with ASIC, and ASIC have said that they will be sharing more information on that lodgement process in due course, but you can expect the same sort of process for what needs to happen when lodging financial reports. And then the deadline for lodgement is in either 3 or 4 months of the end of the financial year, so the end of the reporting period, and that depends on the type of entity. And again, all of those instructions and dates can be found on ASIC's website. The required content within the sustainability report must include the climate statements. So that's basically everything that we've been discussing in these webinars to date. So all of the governance, strategy, risk, and metrics and targets is the climate statements. The notes to the climate statements at this stage, ASIC doesn't anticipate that there would be any notes, separate notes, additional to the climate statements, because the standard is so comprehensive. Basically, all of that information is going to be sitting in the report. It's set in the climate statements themselves, so that would only be required if there was a mandate to include specific notes alongside them. And then the director's declaration about the climate statements and notes, which we will touch on now. So directors' duties, really the directors have a duty of care to undertake due diligence and be asking all the right questions when it comes to their climate-related disclosures and their internal processes. So ASIC encourages directors to build understanding on climate-related risks and opportunities, really build their knowledge and confidence in this area. It encourages them to require that there are systems in place and policies and procedures. So for that director to be keeping the whole team sort of accountable and be encouraging from the top down, really showing that leadership when it comes to the climate-related governance and processes, and also be applying a critical lens to the disclosures. So they should be asking questions such as, well, why have we done it that way? Why wouldn't we do it this way? Or how have you come to that conclusion? Or really challenging some of those assumptions is what ASIC is encouraging. Directors will be required to declare that, in their opinion, the sustainability report is in accordance with the AASB S2 requirements. However, for the first 3 years, directors are only required to give a qualified declaration where they state that, in their opinion, the entity has taken reasonable steps. So there's basically a 3-year sort of grace period to help those directors build their confidence to be able to make that more formal declaration. Just regarding sustainability records, it is also a legal liability to be keeping sustainability records on file. So your sustainability data, all of the documentation and methodology that underpins your calculations and your risk assessment processes, that's not just important for the auditor, it's actually legally required for you to be keeping that information on file and has to be retained for 7 years after the report is published. This is not new. This is very standard practice for any sort of environmental auditing. But yeah, there's some examples here. And again, this will all be in the guide of the type of sustainability records that you would be likely needing to keep on file for that lengthy period of time. And then just finally, compliance risk. So ASIC's role in administering and enforcing the standard under the Corporations Act is really just making sure that organisations are meeting the requirements of the standards. Their role is not necessarily to say if you're doing good or bad, or to make a judgment on the quality of your transition plan or your targets, for example. They're purely there to make sure that there's compliance in place. Consequences of non-compliance are really significant. So there's potentially fines of up to $15 million, fines of up to 10% of annual turnover and or reputational damage, and of obviously potential regulatory scrutiny. However, there is a modified liability period, which you may have heard about, and essentially that means that during this time, ASIC is the only one who would be able to enforce proceedings initially. So there's protected statements, and it means that any sort of general member of the public can't sue, well, within grounds, shouldn't be able to sue you for saying something that is incorrect, misleading. It's yeah, basically an ASIC protected zone where you've got a little bit more time in order to get confident and make sure that that what you're putting out there is in accordance with the standards. So we don't have too much time to be able to chat through all of that in more detail, but again, it'll all be in the guide. So with that, I'm going to hand over to my colleague, Sophie, who's going to quickly run through where to look for further guidance.
Perfect. Great. Thank you so much, Abby. And yes, so I'm just going to be looking at where to look for further guidance because here, while mandatory climate kind of disclosure is relatively kind of new in some jurisdictions, there are some places that you can look for guidance and seen some kind of interesting examples of it. So we've listed out 4, just they're kind of sort of in decreasing relevance because, yeah, the top one that I'll talk about there is really useful. And that is that the first IFRS S2 aligned reports are expected to be released this year, so in 2025, especially if that's covering people who have been disclosing under the calendar year from the 1st of January. 2024, and these are the really good ones because they are going to be kind of the ones that are most similar to the ASRS, given the kind of near identical scope. So that's a really good one to keep an eye out for. But then going kind of down the list, that local organisations, especially financial institutions, super funds, for example, will have been working through producing TCFD aligned reports for a few years now. So that is quite a good idea to have a look at those, although we do note that the scope of that is not as kind of identical, and that's they were more based on the TCFD. We can also look across the ditch to our friends in New Zealand. They have got climate-related disclosures, a CRD legislation. And again, there might be some useful kind of tips and tricks that you can get from those. But again, that's not quite as aligned as what we've got here. And lastly, businesses can also look at the CSRD, so what's coming out of Europe. Although, as we've flagged, they are going through quite a transition period at the moment with the omnibus coming in. So essentially under that, just the requirements are likely to be finalised this year, and many haven't kind of reported yet. So where you can get this actual guidance from, we really recommend you kind of get familiar with the AASB S2 standard, which is related. You can find this link here that you can hopefully see on the AUASB website. And there's also some further information on ASIC. There's a really good guide you have be able to see, which is looking at the IRFS S2. There's an implementation guide, which provides really good examples of kind of how you can display some of this information, especially in tables, where you can display several disclosure kind of information bits kind of concurrently. And those are really useful things. There's also a little screenshot there you'll be able to see of the ASIC Regulatory Guide 280, which is otherwise known as the RG 280, which was released in March this year, which has a fairly comprehensive guide on sustainability reporting, and it kind of covers things like directors' duties and materiality and those good things. So recommend looking across at that. And even more guidance, there's kind of, we recommend looking at the top 2 there. So along the top, more further Australian guidance. So for SMEs in particular that are not yet captured under the legislation, ASIC again has some further resources for those businesses, and they cover kind of topics such as who must prepare disclosures and kind of a historical development of climate-related disclosure. So that's a really useful set of implementation. There's also the Australian Accounting Standards Board that hopefully has a really useful FAQ section. Some of the topics are not dissimilar to what we've talked about in our webinar series. So you can work through the FAQs, which again, super useful in practice, and can look overseas. Again, you can see the reports from overseas, but overseas they've also got good guidance documentation. Again, in New Zealand, they've got some good guidance docs, and especially from the EU as well. But with that note as well, they're not directly aligned. And the last one there on the right, if you can see that, is the ASRS's 5,000 implementation guide, which is a fairly hefty guide, but is quite specific to assurance and the assurance process. So really useful especially for companies that are looking to do their assurance processes, and if they haven't had that much time to do a pre-assurance or only done a limited assurance practice run. So we do just kind of want to flag now, because reporting standards, they really have increased so much, kind of the bar's really been lifted. What does that mean for performance standards? So performance standards, we mean kind of like an SBTi validated target, or perhaps getting B Corp certification. Like, what is the role of that now? And do they still play a role, these performance standards? And our kind of simple answer is, well, yes, very much we do see the role of that, especially because these performance standards now are evolving, especially in the world of legislation, that they've now pushed the boundary forward once again, which is fantastic. And again, we heard from Renzo last week at Bank Australia that was exactly in this position, just a fantastic business that's now kind of looking around themselves and going, cool, what's next? Like, what else can we achieve? And those performance standards are now really, still serving as that differentiation between those that want to really achieve even better good things and those wanting to achieve minimum compliance. So very much a role still for performance standards in this space. We do note, however, there is a bit of a a tension between balancing compliance. So there is a view of looking at this as quite risky on one hand, and also how do you balance that with ambition and wanting to do good stuff, and at what point does accountability become liability? And we want to just kind of pique your interest and point you towards the BLAB AANZ team have kind of produced a really good thought piece on this. And there's some really great quotes of how companies kind of have been balancing this and looking at it. The second one there is the goal should always be to deliver real impact and not just box ticking, and that's kind of where we would love to encourage people to look at mandatory reporting as well. So it's not just box ticking, but hopefully using the standard to drive real innovation. And we do really see this as a really exciting time then in corporate responsibility and accounting. So with that, Abby, I'm going to pass back to you.
Beautiful, wonderful. Thank you very much, Sophie. So with that, I do invite our guest speakers to put your cameras back on, and I would like to introduce Emily Simso, who's the Manager of Sustainability and Impact at New Forests. We'll then have Sophie Degary, who's the Director, Climate Change and Sustainability at KPMG, followed by Nina Katrine Larsen, who's the founder and director at Reground. And as we mentioned last week, we wanted to ensure that we had a range of different perspectives in these guest speaker presentations and discussions to ensure that we're sort of capturing the audience, because we know that a lot of you aren't captured under mandatory reporting, but a lot of you are. So we want to make sure that we have both larger reporting entities' perspectives as well as SME perspectives who are doing a lot of this amazing work voluntarily. So with that, I'm thrilled to introduce Emily, who's going to kick off our guest speaker presentations. And Emily has a wealth of experience in all things corporate sustainability. She's got an environmental science and research background, and works with New Forests team globally to integrate sustainability across the investment process. So over to you, Emily.
Brilliant. Thanks, Abby. And hey, everyone. It's lovely to be with you all here today. As Abby said, my name is Emily, and I'm a member of New Forest's Global Sustainability and Impact team. So we can go ahead and dive into our approach to climate reporting thus far. This is just our legal disclaimer that the team has us include in all of our presentations, so we can tick the box and move on to the good stuff. Thanks, Abby. So really just quickly at a high level, who is New Forest? So we're a global natural capital investment firm founded in 2005. We're now one of the largest firms globally focused on natural capital. We manage about 4.3 million hectares in Australia, New Zealand, the United States, Southeast Asia, and Sub-Saharan Africa. And that's split across forestry and agriculture investments. Next slide, please. So our approach to climate reporting started in the voluntary space back in 2020. And since then, it's really been a process of continual improvement. For example, updating our risk assessment processes, expanding our emissions reporting to include all 3 scopes, and then receiving limited third-party assurance over that emissions data. I think we had to, recognize from the start that this was going to be an iterative process, but it really does provide a foundation for us now to be more prepared for the mandatory disclosures. And I think having this strong foundation has also been really crucial for us in terms of stakeholder engagement. Our staff are now much more comfortable with climate topics than they were a couple of years ago. But the mandatory disclosures we do recognize really raises the importance of having our, finance and risk teams much more closely involved in the reporting process and trained on these topics. And so where we are now is we're currently completing readiness assessments against the disclosure requirements, and that's at the asset, fund, and New Forest corporate levels, so we can understand where are the gaps and what do we need to continue to work on in the next couple of years to help us disclose. We don't have to report until group 2 for some of our funds, and then corporate is in group 3. So thankfully we have a little bit of breathing room and can use that longer runway to prepare. Go on the next slide, please. So just wanted to touch on a couple challenges kind of related to that continuous improvement process we've been on. The first one was recognizing the need to reduce complexity. So when we first started, our climate risk assessment was way too complicated to make a decision useful. Our emissions data collection process was very manual, and our net zero modeling tool was just simply not efficient. And so we recognized we needed fit for purpose tools. So we moved all of these processes online and then streamlined to really focus on what's material. So just as an example, in our emissions data collection, we no longer collect data for emission sources that are less than 2% of an asset's footprint. And that's recognizing, balancing time, the time needed to collect data versus what are you actually getting out and how is that helping you make decisions. Second challenge we had was on stakeholder engagement, and then recognizing that we need to get both top-down and bottom-up support and oversight to make this really efficient and effective. So we've held workshops with internal staff and our external property managers to communicate the value of doing these assessments. We've also updated our reporting structure to the board. We now have a dedicated committee that just focuses on sustainability. And as I mentioned, we brought our finance and risk teams into this process as well. And then just briefly touching on risk also, one of the key things we've also learned is the need to include climate within our holistic risk management process. So we've brought that into our enterprise risk management system that sits at all levels of our business. And we've also, using net zero as an example, also recognizing that we need to include all of these processes into our overall business planning. So if net zero isn't part of your financial model, it's not part of your strategic plan, it's not going to get resourced and managed. So really need to integrate all these pieces together. Just next slide, please. And then finally, what are we looking towards the future? So it'll really be focused on the outcomes of these readiness assessments that we're working on right now to make sure we can be compliant. But some things we're already thinking about are updating our climate tool that we're using to make it a bit more sector specific. So for example, how is climate impacting the yields of agriculture products? We want to update our governance processes even further at each of the fund, asset, and corporate levels to make sure these roles and responsibilities explicitly are including climate. And we as a global business are also looking to streamline and how can we coordinate across all the jurisdictions where we're operating, recognizing that these mandatory disclosures are only going to become increasing relevant globally. So I will stop there. And yeah, thanks so much, Abby.
Great. Thank you so much, Emily. It's really fascinating to see that evolution of your process and just see how you've changed those systems and streamlined things. And I think that's no doubt the journey that many organizations are just now embarking on themselves, having perhaps not been doing some of that work historically. So yeah, really fascinating. Thank you for sharing those insights. Next up, we have Sophie Degani, really thrilled to introduce Sophie, who's a director at KPMG's Climate Change and Sustainability Services team. She's got over 15 years of experience in a range of different aspects of sustainability, including climate reporting, circular economy, and environmental policy, and is working closely with many organisations on their own mandatory reporting preparatory journeys. That said, I guess KPMG is also going to be required to report under the ASRS themselves in due course as well. But I'll hand over to Sophie, who's going to share more about what she's seen many organisations challenge with.
Great. Thank you, Abby, and good afternoon, everyone. So, Sophie Legani, Director at KPMG in the Climate Change and Sustainability. And as Abby was saying, we are currently helping quite a few companies, and also reporting ourselves. So I'll just go through a few challenges. First, a roadmap of where we see the different companies and where they are at actually, and the different steps there is, and some challenges or consideration that would need to be seen or sort of at some point in the reporting process. And first, I'd like to acknowledge the traditional owners of the land on which I'm sitting today, which is the Gadigal people of the Eora Nation, and pay my respect to elders past and present. Thank you. The next slide, please. So in terms of the ASRS and mainly ASSP S2 implementation, there seems to be different phases. So first, we start with the impact assessment, which is really what Emily was thinking as talking about the gap assessment. So where are we? Where are we sitting in terms of what do we have to do and what we are currently doing? Where are the gaps? Then we go into the project planning and see what needs to be done. So the key activities which would need to be done to be compliant. Then there is the maturity assessment. So looking at all the processes, the data, where it's coming, what's available now, what would need to be available. And then going into a reporting transformation. So the companies really look inside within their organization, what needs to be done to change the current process and to be compliant. And finally, assurance readiness. So depending on the groups, of when you need to report, there will be the pre-assurance first, and then limited assurance and reasonable, which will be across several years. So again, depending on your company, the size, the group you belong to, the availability of resources internally, of the support externally, you would be at different phases in this roadmap. But I think there are some key considerations that we are hearing in any of these phases, really. So if we go to the next slide, please, Abby. Some of this consideration, though, would be so in terms of global reporting. So if you are part of a global company, it's mainly to apply some consistent boundaries because the disclosure would need to be consolidated, though, into the similar to the financial reporting. So the boundaries would need to be similar. If you are global, you would need to apply probably the IFRS S1, S2 principle, because they are the one operating across multiple jurisdictions, and watch for the double counting or the omissions, depending again the local reporting versus the global one. In terms of connectivity as well, sustainability disclosures must be connected with the financial statement. So you would need to align all the climate-related assumptions. That could be the carbon pricing, the asset lives with the financial forecast, and integrate the climate risk into all the impairments assessment, the contingent liabilities, and the capital planning. And that's mainly to make the sustainability reporting, the climate reporting, connected to the financial statement. In terms of the assurance, so even before going into the reporting and preparing all your disclosure, you would need to understand whether you would be going for one or two separate two opinions for the assurance, and prepare early to ensure the data and documentation and the controls are ready. That's where I think the pre-assurance would be very beneficial for many organizations. And another consideration would be for some funds under management. Again, the asset managers will have to report sustainability impacts relating to the managed assets. And that's probably only for some of you or for not for everyone. But it's to clarify whether the funds under management, the disclosure would relate to the own operation or to a portfolio company or to both. If we go to the next slide, please, Abby. And then more in terms, again, I was mentioning the boundaries initially, but it's really being clear on the organizational boundaries. And that's NGER versus the greenhouse gas protocol. Many of you would have been reporting against or are reporting against NGER. ASRS recommend using the greenhouse gas protocol and not just the NGER boundaries. However, you would need to decide early what would be applied and to be consistent. That's mainly the main thing, is to be consistent in between across the whole reporting. In terms of scope 3 emissions as well, the periods and the estimates. So the period would need to align to the financial reporting. So the 12 months would need to be the same as the financial reporting for the scope 3 emissions. So we need to make sure if you are January to December would be the same, because at the moment it might not be the case, and the sustainability reporting might be at different periods. So that would need to be aligned. And also disclose all the basis for the estimates and any material exclusions or the improvements over time, because scope 3 is the hardest one to do, and so there will be some estimates at least on the year 1 or year 2, and then see how that will change year on year. Then in terms of the emission factors, that you would need to disclose which emission factor will be used, if it will be NGERS, DEFRA, IPCC, and then again, consistency across the reporting, maintain the consistency across the periods or the entities where relevant, and also update the factors regularly, because it can depend on the region as well as industry-specific choices. And finally, in terms of the risk and opportunities, the definition and the materiality, and that's what Abby was talking about at the beginning as well. It's making sure to define the climate risk and opportunities relevant to the business. So that's in terms of materiality. There is no materiality required. However, you would need to make clear that the risk and opportunities highlighted are the one relevant to your business, and that's where the materiality would be beneficial. ASRS doesn't require a double materiality lens. However, if you are part of a global company again, or if you want a global alignment, it is encouraged to conduct the double materiality, which would be a financial and impact materiality. But that's probably just mainly for the global companies. So that's some of the consideration we've seen, and some that we are also applying to ourselves. And we'll be happy to answer any more questions if there are some later. Thank you, Abby.
Great. Wonderful. Thank you, Sophie. I think it's just clear to see just how many of those specific nuances and scenarios there are once everyone starts diving deeper into it, and just shows how important it is to start early on to be able to work through all of those queries and challenges. So thank you so much for talking through all of those. We'll have more time to discuss them in the panel discussion after Nina runs through her slides. So last but not least, very pleased to introduce Nina Larson, who is the founder and director of Reground. And I'll let Nina introduce Reground, but I'm sure many of you might know Reground's work already. But Nina is a great example of an organisation that is not required to do this legally, but is already engaging in a form of climate and impact reporting that makes sense for Reground as a business and is connected back to their business model. So yeah, Nina is a behavioural design specialist, and she's got over 10 years experience in designing and implementing sustainability solutions across various organisations. So hand over to you, Nina.
Thank you so much, Abby, and also thank you so much to the CitySwitch team. I just want to, before I start, acknowledge the traditional owners of the land that I'm coming to you from, the Wurrung people of the Kulin Nation. I just want to start by saying, wow, I'm just in such awe of all of you specialists that are sitting with this information every single day and are still super energized by it, because I feel like right now I am kind of representing the small to medium-sized businesses that are coming into this space. And I'm acknowledging that we are 98% of businesses in Australia. We employ 2/3 of the workforce. So it is critical that small to medium-sized businesses really get in with the new reporting requirements and do it in a way that's hopefully not adding to like the workloads that we are already kind of some of us burdened by, but it's this interesting space where we will all have to work together to kind of get this done, and I'm excited about that. Yeah, as Abby said, maybe some of you will know about our work. Reground is a social enterprise started 10 years ago. We started with collecting coffee grounds. We collect chaff, another byproduct of roasting coffee, and then also soft plastics. We have been around for 10 years, and we've kind of evolved with the need of system change. And now we also do a lot of waste audits and do a lot of education programs. So I think just to set a tone for like how I'm coming to data and reporting, just because it kind of matters, I guess, in terms of like why this is important to Reground. I'm from Denmark, and in Denmark, you know, if I say I'm doing one thing, I have to prove it. And so I'm not doing data because the government is telling me to, but because I think it's ethically the right way to run an organization. So the first very bin that we collected, I have the data point for that. I know where I collected from, where it went to, and how much I collected. So Abby, maybe go to the next slide. We track data. I want to say, as a small to medium-sized business, what's really critical is really making this, it's better to do something than to do nothing. So understanding what data is really important for your organization and your supply chain, your value chain is really critical. For us, it started with obviously the obvious ones, coffee grounds, how much we're collecting. We made a calculation of emissions that we saved from not having that put in landfill. We also have recognized very early on that really reporting on something that's where I think data becomes really interesting is when it becomes a part of your storytelling and humanizing data as well. So really speaking to the people that were receiving this information. So very, very early on in Reground's 10 years journey, we actually invested in software that could help us collect this information, send it to our clients really easily. That meant that my team wasn't burdened by the data collection. And I think that is one of the challenges that we're all facing is like, how are we actually going to get this information? So to sort of take it outside of the direct impact that is related to our service delivery, like what's the impact of Reground as an organization? 10 years ago, I could not buy EV vehicles. I run a logistics company, so running a diesel fleet was obviously something that was really bothering me. The impact framework we are working with in Reground, and I will say it's pretty basic, and I actually want to encourage our small to medium-sized businesses to start there, because if you cannot get like the basic data right and just understand what actually matters for your organization to measure, then you are just going to be caught up in that area of like not really doing much and feeling potentially very overwhelmed. So for me, it was like, what's the lowest hanging fruit? So our team sat down and said, okay, look, our logistics emissions are really important. Abby, maybe go to the next slide. And we used a lot of water to clean out our bins. So we wanted to track water usage. And things like how we travel how we commute in our team were really important. And so it really guided us. So we are now having like internal, very basic spreadsheets, plus just some every single year we sit down as a team to talk about like what are data points that we want to capture that can give us help us tell a story on emissions. Internally. So we're starting from us. Why is because we are an impact business, so that helps. But also, obviously, we use it for example, projects that we're running with, like for any project we run, we always do a project impact statement. So, but to come back to the logistics, it was so important. That was just the lowest hanging fruit for us, was just like flip the fleet to EV. And some other things we don't have control over so much is the energy we use at our offices, because we are kind of relying on our landlords to do this, but we can push. So our data and impact measurement is actually giving us very clear instructions and actions for sort of strategic actions within the organization. So yes, it's really hard. I think it's going to be really tricky, and we will have to collectively kind of help our small to medium-sized businesses that are not impact businesses. So if you don't have a why that's literally about having as much positive impact as possible, then you're not necessarily going to be naturally motivated by these climate reporting standards. So we're going to help people understand how fun it can be. And that's one of my things with data, is that it can be really fun. It can be really exciting. It can actually help connect people, because at the end of the day, if data doesn't translate down to a behavioral level, this is all for nothing. Like, it's really all well and good to know stuff, but if you don't do, and if we don't change, then we're not having the impact we want to have. So making it fun and humanizing it is really going to be the biggest challenge for I think people in my on my level. And yeah, we all play a part and a role in sort of helping. So yeah, that's Reground, and that's some examples of how we report to our clients.
That's amazing. Thank you, Nina. I think that really helps, to bring it to life for smaller businesses, showing what's possible. And I love that last point, making it fun and making it meaningful to the business. So I'm sure that will have resonated with many on the call. So thank you so much, everyone. With that, I want to just stop sharing my screen while we run through some questions for the guest speakers. To begin with, and just to remind everyone, if you did jump on late, we do plan on staying on here for 15 more minutes. So we plan on having at least, hopefully 5 to 10 minutes of facilitation between the speakers, and then we'll have some time as well, at least hopefully 5 minutes from audience Q&A questions. I can see there's already some great Q&A questions that have come through. So if you do have a question for Emily, Sophie, or Nina, please post it in the Q&A. I just wanted to start with a question to Emily. Just wondering if you can expand a little bit more on some of your challenges or methods of navigating some of the finalisation of the disclosures in the past. So particularly the materiality or internal reviews within your team. What have been, some of the main sorts of challenges related to some of the themes we've been discussing today?
Yeah, so maybe on the materiality side, I think one of our challenges when we first started was, so we collect data at the asset level, and we work with external third-party property managers that provide data up to us, including this climate risk process. And one of the challenges was, we were asking people to assess these risks without a really defined, risk thresholds and consequence likelihood matrix. And so actually, we weren't sure at the end if people were assessing these risks in the same way. And so we updated that process to use our standard risk matrix, asking people to assess them using the same parameters. I think there's still some level of human interpretation in there, but getting much more aligned, because then for us, a challenge is how do we take those risks at the asset level, translate them up to a fund using a defined threshold, and then up to our corporate entity. At what point does a climate risk at an asset move all the way up to New Forest? So we had to get a bit more consistent about how we were going to communicate those risks and include them in the various levels of disclosure.
Yeah, interesting. So many layers to it, and then having a system that makes sense to be able to work through that entire process must be a big challenge. So that's interesting. And Sophie, I was wondering, in your perspective, if you have any related comments to that, or if there's organizations that you work with where you see like something that should have been done early on in the process, perhaps that hasn't been done, that then makes it challenging later on for a business? So such as, the organizational boundary setting, or if there's anything in particular you wanted to call out.
I think, yeah, I mean, the organizational boundaries is one thing, but it's mainly the alignment with the financial reporting as well. And being consistent in between both, that being for any estimates that they would be used, or any of the boundaries, but also the standard of the assumption being used. I think the consistency and the integration of the sustainability climate report to the financial is the key things, and is the main consideration to have in mind right at the beginning, and that if it's too late after it, there would be a lot of changes to be made on one or the other, or usually on the climate one as well, to align it.
Yeah, that makes a lot of sense. What about in terms of another question for you, Sophie, in terms of helping directors build their knowledge and confidence in the climate disclosures, particularly around uncertainties with Scope 3 emissions and then needing to sign off in a director's declaration? Are there some key things that you see directors that KPMG works with undertaking in order to help build their confidence?
First, right at the beginning, the upskilling is very important, and that's for directors, for any board members, for any of the management team, to upskill themselves in this area. Second will be in terms of the governance. Sometimes it's not really clear on who is actually responsible to approve the materiality, the process, and the definitions, and that could be where there are some discrepancies as well, and you are not going to the right person. So being clear on the governance for all this reporting to pre-approve this, and then also on the accuracy of the information, and see where it comes from, and really the directors will need to have a defendable position on where these numbers are coming from, where this data is coming from. So that's mainly to reinforce and question these processes.
Yeah, good. Makes sense. No doubt, a journey that lots of directors have to go on now. And then Emily, again for you, I was wondering, so New Forests is currently a certified B Corporation, and you've been doing lots of amazing work in different areas for many years. Wondering, we asked this question to Renzo from Bank Australia last week too, but I'm interested to pose it to you also and see your response in terms of how New Forests is navigating, balancing now that compliance focus with ambition and your role as a B Corp and being a leader in this space. So how have you found the implications of mandatory reporting on your B Corp status?
Yeah, it's interesting. I think the mandatory disclosures, it brings a level of attention to this topic that, when it's voluntary or people are like, oh, we're just doing it because we're a B Corp, which isn't why we're doing it. But, any perception, it kind of pushes through that. And now it's a regulatory requirement. But I think it's exactly right. We don't want it to be a tick box. We don't want it to just be this, annual report we do at the end of the year, but really a part of our business process, strategy, and investment thesis. And so it's helpful because we're getting more dedicated resourcing, but we don't want it to become just a reporting burden and an obligation. So really, I think, and that's part of our journey that we're going on with the mandatory disclosures as we work through, even further integration of climate into our strategy and processes, is just a lot of that training with staff. And why is this valuable? How does it help people do their jobs better? How does it help us get better returns for clients, and not just, oh, this is something we have to do? So probably a bit on that staff education piece. And I think it's top of our mind as well. There are some headwinds globally on this topic, particularly in the US with the pushback on ESG and net zero, but we're just keen to keep moving forward, and not just in climate, but as a B Corp, there's so many other topics we can keep working to advance. And maybe avoiding a bit of the noise that's happening from the US and elsewhere.
Yeah, great. Good. And then maybe for Nina, I was wondering if there's anything you can share in terms of best practice guidance or inspiration for voluntary climate reporting as an SME. Is there anywhere that you look to help guide your processes or your strategy in this area?
I think it helps to have a very strong network of people that are constantly looking into this. So like I'd say, for example, the CitySwitch framework right now for us is really helpful because, to be honest, it's about making it really easy to do, especially when we go outside of sort of the focus areas of our organization. I mean, I always look for guidance in the government because this is just where it all comes from. So, I think, I don't know if this is so applicable to other small to medium-sized businesses, but like, obviously the actual legislation, you gotta, understand that. But yeah, I would say community, and that's why like these networks are really critical and just like, having guidance, because it also will help actually minimize the workload for some of these very busy operators.
Yeah, great. Those case studies such as yours are just critical, I think, to bring it all to life for people, aren't they? Great. So we do have some questions from the audience for our speakers, which we'll go through now. And while we do that, I'm just going to pull up a QR code on the screen because we've only got just over 5 minutes left. So while we're running through the audience Q&A questions, we do encourage feedback on today's webinar. So we'll just leave that up on the screen. Yvonne, did you want?
Yeah.
Great.
Could you put that in presentation mode, Abby? We can see your notes there.
Yeah.
So the first question was from Robin Heslop for Emily. So the question was, as a global business, which is delivering reporting with a global lens, what allowances and additional processes have you had to introduce to implement reporting specifically to ASRS 2 in Australia, assuming that you can't just use your global materiality and disclosure and apply these directly to Australia?
Yeah, so we're working through that process now of, what do we have from the global kind of voluntary experience that's meeting the requirements of S2, and then where are sort of those gaps and the additional considerations. And part of that will certainly be looking at, the climate analysis and scenarios that we're using for the region and making sure they're fit for purpose. We do plan on using as much as possible, like our global materiality approach, having consistent responsibilities for directors, at the manager board level for our funds, et cetera, because ultimately we want to be consistent. But I think where we're getting some of that regional specificity will really just be in the scenarios and the tools that we're using to complete those assessments.
Great, thank you. Another question, more broadly. So this question is, who can do the assurance of the greenhouse gas inventory being reported under AASB S2 in the financial statements? Does it have to be an auditor assuring the financial statements, or if they are very technical emissions heavy company, can it be an engineering company or the company that better understands the company emission sources and opportunities for improvement?
I'm happy to take it. In terms of the assurance, if it's assurance, you would need an assurance provider. So they would need to be certified as assurance provider to conduct the assurance. The engineering company would be able to help to prepare, to get ready for assurance, or to help getting all the data ready and the inventory ready. However, if they are not certified as assurers, they won't be able to provide any opinion. And then whether you would need the same assurance provider for both the financial and the sustainability, no, you don't need to. There will be some benefits to have the same, there will be some benefits to have different, but yeah, there is no requirement to have the same.
Cool, Thanks, Sophie. Another question for Sophie from the audience. So will most companies move to defining their organizational boundaries using financial control method rather than operational to better align it with financial statements? Previously, we saw a lot of greenhouse gas inventories aligned with the operational control method, but does this change now?
You can really use one or the other. I just need to be consistent in between across the reporting. We've seen some switching in between operational to financial, but I wouldn't say there are more using the financial than the operational, or at least we haven't seen that big a change for now.
Cool, thank you. And the last question, is there a AASB S2 summary available that can be utilized to list the requirements in an easy way?
Is that in terms of the checklist? Or if it's in terms of checklist, yeah, there will be plenty of support in the plenty of checklist or support there in the links that Rewild shared initially.
Yeah, and there's not like the standard is really easy to read and easy to follow, but it would be sort of up to the organization to pull it out into like an Excel doc or something like that to be able to tick them off one by one. So there's not a list in any other format than what's on the AASB or AUASB website for for the standard specifically.
Okay. Great, thank you. Well, that was the last question. Thanks for all of those, they were great, and thanks for the all you speakers for answering the questions as well. So we wrap up the session today. Thanks for joining us today for the webinar and the whole series. It's been great having so many businesses engaged with this campaign. A big thank you to Rewild and our great guest speakers. We'll be sharing the recording for this session after this session today. We would love to hear your feedback. So if you can scan this QR code on the screen and let us know how we did, that would be great. And again, please reach out to me if you are keen to have a chat about joining the CitySwitch program. And yeah, thank you everyone, and have a great afternoon.
Thanks everyone. Thanks for joining.
Thank you.
Bye everyone.